look, in terms of this morning's price action and volatility that we've seen intraday, in the FX markets, I think it does highlight the challenges that we've had in the last 2 or 3 months, specifically around the way that FX has been trading in a very, very correlated fashion to what we've seen in equities. So from a perspective of advising our clients at JPMorgan Private Bank, I think it has been actually quite challenging. Notwithstanding that, I would say if we take a little step back away from the Navarro comments and the round trip that we've had for foreign exchange markets around those comments and the walk back this morning, we think that the bigger picture is that the global growth shock that we've seen earlier this year is behind us. Risk appetite is improving, and that should lead to a removal of the support that we've seen for the dollar. And actually, we've just published in the last couple of days our mid-year outlook, which represents a mildly dollar bearish view, I'd say, and we're forecasting a 5% weakening in the dollar index over the coming year.
Right, fair enough. And so what would that mean essentially for emerging market currencies? Because obviously a weaker dollar would fuel money into emerging markets.
Yeah, look, I think we're relatively constructive. Obviously, this region, I think if you compare to what we've seen across CEMEA and LATAM, I think this region has been a little bit more muted in terms of the price action, both on the way down and on the way back up this year. Obviously, the one fly in the ointment that we have to always consider is potential moves in the Chinese currency. No surprise, I think that we can expect further jawboning, I think, from the US administration. I think Trump's modus operandi is fairly clear to most of us following markets over the last 4 years. So I think that's one thing we need to keep an eye on. So, in a standard dollar weakening environment, we would expect that to be positive for the Asian currencies, but I think we have to keep an eye on what's happening in dollar China and the extent to which that will impact the broader region.
Yeah. And Adam, that's why I think it's so important to ask the question as to what happens with these U.S.-China trade tensions from here, because even though sentiment has been calmed by the fact that both Peter Navarro came out and clarified and then Trump said the trade deal is intact, the fact that they're both highlighting just how bad the state of trust, the lack of trust is between the two, says to me that this isn't over. And it makes me wonder that even though they're saying the trade deal is intact, what will China do on their end? Because they may say, look, if we don't have trust between the two sides, how can we make this work? And then once again, could you see risk sentiment take a hit?
Yeah, I think that's a great question. It's in line with our view. I think over the next 4 or 5 months into and around the US election, we're definitely expecting a continued pickup in tension. Obviously, in the last weeks, we saw dollar China trying to make a breakout of the range. 720 is now really a pivotal level, I would say, on the top side there. I think we've been a little bit calmer, with broader weakness in the dollar index, but we don't think that story is over. Many of our clients, are consistently looking at ways to hedge that China exposure, and we certainly think that tail risk is for further strength in the dollar versus China. So we don't think that story is over, and it's certainly something we're going to have to keep a close eye on in the next 3 or 4 months.